8 times a year, a small group of people meet behind closed doors in Washington. And at 2 p.m. Eastern on the second day, they release one short statement that can swing trillions of dollars across global markets in minutes. Everyone calls it the Fed meeting. Its actual name is the FOMC, and the number everyone waits for usually isn't the thing that moves the market. Quick distinction, because it trips people up. The Fed is the institution, the central bank of the United States. The FOMC, the Federal Open Market Committee, is the group inside it that actually sets interest rate policy. We've got a separate explainer on the Fed itself if you want the full picture. This one's about the committee, the room where rates get decided. So, who's in the room? The Fed's 7 board governors, based in Washington, all vote. The president of the New York Fed always votes too. And the remaining seats rotate each year among the other regional Federal Reserve Bank presidents, 12 voting members in all. The chair runs the meeting and sets the tone, and the chair's words carry more weight than anyone else's at the table. The committee meets 8 times a year, roughly every 6 weeks, and each meeting runs 2 days. The decision drops at 2 p.m. Eastern on day 2 in a written statement. Then, 30 minutes later, the chair holds a press conference, and that's often where the real fireworks are. What they're deciding is the federal funds rate, the target for what banks charge each other to borrow overnight. Sounds narrow. It isn't. That one rate ripples outward into mortgages, car loans, credit card rates, business lending, and the price of risk itself, stocks and crypto included. Move that lever, and everything downstream moves with it. That's why a committee most people never think about ends up touching almost every dollar they own. At the March, June, September, and December meetings, the Fed adds something extra, a set of projections called the SEP, and inside it, the dot plot. Every member marks where they think rates are headed over the next few years, anonymously, 1 dot apiece. And here's the part that surprises people. Markets often react harder to the dots than to the decision itself. The rate move is what's happening today. The dots are the map of what's coming, and the map is what traders are really trading. Hawkish and dovish, you'll hear those 2 terms every single time. Hawkish means leaning toward higher rates to fight inflation. Dovish means leaning toward lower rates to support growth. The moment the statement lands and the chair starts speaking, every trader on earth is parsing the tone on that exact spectrum, sometimes down to a single changed word from the last meeting. So next time you hear, the Fed meets this week, remember what the suspense is actually about. It's rarely the rate number. That's usually the part everyone already expects. It's the direction. A meeting with no change at all can still send markets flying if the dots shift or the tone turns. The decision is the headline. The signal is the story. We cover the markets on the days that actually matter, with explainers when it helps. Hit subscribe so you don't miss it. We'll see you next time.